Mr. Parameswaran Iyer, Secretary, Ministry of Drinking Water and Sanitation, Government of India, to come to the dais. He is the chair of the session. We have other distinguished panelists of the session, Mr. Kenichi Yokohama, Country Director, India Resident Mission, Asian Development Bank, Mr. Sujoy Bose, CEO, National Investment and Infrastructure Fund, Dr. Kumar V. Pratap, Joint Secretary, Department of Economic Affairs, Ministry of Finance, Government of India, Professor Om Mathur, Senior Fellow and Head, Urban Studies at the Institute of Social Sciences and New Delhi. All the panelists, we are requesting to kindly come to the dais. And I request Sri Iyer sir to take over the session.
I don't need this. Are we? Can you hear me? Yeah, okay. Thank you and good afternoon to all of you, and welcome to this session, which is titled Infrastructure Initiatives in India. We have got a very, I think, rich and experienced panel here with us today. My name is Parameswaran Iyer. I am the Secretary in the Ministry of Drinking Water and Sanitation. We have a few infrastructure initiatives of our own in rural India. I'll come to that in a bit, but let me first introduce our very distinguished panelists, and then I'll open this up with a few remarks, and then we'll take it from there. So on my right is Mr. Kenichi Yokoyama. He's the Country Director of the Asian Development Bank in India. He's got a very rich operational experience, particularly in the water resources sector, but he's worked on other infrastructure sectors as well. And we look forward to hearing from him about giving us a multilateral and perspective on financing infrastructure. On my extreme left is Sujoy Bose. Sujoy is the Managing Director of the National Investment and Infrastructure Fund. Sujoy has got many years of experience in the World Bank Group, in the IFC. He came back to India a couple of years ago. And Sujoy is going to be talking about private sector financing of infrastructure and give you an international perspective as well. On my left is Vinay. Vinay is Joint Secretary in the Ministry of Finance, looking after infrastructure in particular. And he's going to be talking about 2 or 3 initiatives under the Ministry of Finance and giving you an overview of the government's role and the part they play in financing infrastructure. And last but certainly not the least, Professor Om Mathur, one of the pioneers in the urban sector. And Professor Mathur has been teaching all of us about urban infrastructure for many, many years. I've known him for a very long time, and all of you know about him as well. He'll be focusing on the urban sector, particularly the financing aspect. So let me just make a couple of remarks about this whole rapidly growing infrastructure sector in India. And I'll talk a little bit about my own sector after that. So, we've heard in your earlier session, which Subhash was chairing, all the entire thrust on financing infrastructure. And of course, in the run-up to the annual meetings of the AIIB, which is precisely about that. So, there are different estimates about this, and I can throw out some numbers. But in this year's budget itself, there's over $100 billion focusing on infrastructure in different sectors, whether it's energy, roads, housing, waterways. So there's a big thrust already. And one estimate is that by 2022, the annual investment is going to be over $600 billion, and it could even be more. So there's a big policy prioritization on infrastructure. And I think that this is seen already in sort of works on the ground, whether it's on roads, whether it's on housing, whether it's in my sector, which is water and sanitation. So let me talk a little bit now from my perspective, before you hear all the experts from other sectors on rural infrastructure. Again, this has become a major sort of sub-thrust, if you like, of the infrastructure sector in India. And whether it's housing or rural roads, or rural energy, or sanitation and water. And in particular, one of the flagship programs in infrastructure is sanitation, and rural sanitation in particular under the Swachh Bharat mission. Actually, I should take a step back and say that for us, this program is less about infrastructure, ironically, and more about behavior change. So a lot of toilets have been built. I was talking to Partha about that before this session. So if you just want to look at the big numbers, 75 million toilets have been built in rural India in the last 3.5 years. And so there's been a major increase in sanitation coverage in India under this program. When the Swachh Bharat mission started, the rural sanitation coverage was about 39%. Today it's 86%. The good news is that usage of these toilets, which is essentially what we are talking about, is over 90%. There have been 3 independent surveys, large-scale surveys, and they all show that usage is very, very high, which shows that something is happening on that behavior change front. It's in many ways become a people's campaign, or what in Hindi we call a Jan Andolan. And so as far as the infrastructure part is concerned, you could actually say that, we go back to that old Tata Steel ad, which some of you of my generation might have seen. We also make steel. So actually we also make toilets because, we want people to use them, and they are. But the financing of this is also very important. So between the central government and the state governments, over $20 billion would have been spent on the Swachh Bharat mission. So that's the commitment which the government has given to financing this public good, which is sanitation. And this is going to continue. It's actually become a very big market. So there's an opportunity for investors, maybe more in the MSME sector. But the Toilet Board Coalition, which is an independent body, estimates that this market in sanitation is going to cross $50 billion in the coming 10 years. And so as we move from open defecation free, which, if we are on the last stretch, to open defecation free plus, which is solid and liquid waste management, there is a big market for investment and for entrepreneurs at a local level. You need to retrofit toilets. People need to take loans. So there's a whole financing and microfinancing game going on the ground in many states. And so, but there's also the supply chain which needs to be taken into account when you stimulate demand for toilets. So there's a big market in rural areas. We have not yet tapped into this. And it's very important that this becomes a business so that it can be sustained. So we're very focused on the sustaining on ODF, the moving into solid and liquid waste management, initially in the census towns, which are the more densely populated villages. So again, a lot of investment gone into sanitation, infrastructure, and then there's the rural water infrastructure in particular. So there's a program of the government called the National Rural Drinking Water Program, and rural water is becoming a major priority for the government. The coverage, if you look at basic coverage in terms of 40 liters per capita per day, is about 78%. But pipe water supply in households, or what we call private connections, is only 17%. So there's huge headroom to expand in the water sector. Urban, of course, and I'm not talking about urban at the moment, I'm talking of rural India. So there are a large number of habitations because everyone aspires for a household connection. And many states have done this on their own. So Telangana has invested 44,000 crores, that's $7 billion, on providing household connections in every household across the state. So many states are increasing their spend on water supply. Many of the international organizations are financing this. ADB does a lot in the urban sector. The World Bank has done a lot of financing in rural water. And I think there's tremendous scope again there in terms of coming in terms of investing in infrastructure in rural water. Importantly, however, it's not about infrastructure, it's about how do you sustain those investments. What are those good practices? Are we recovering the costs for operation and maintenance? So I think the whole reform agenda is now upon us, and it's up to us now. We made a beginning by putting rural water on challenge mode, making it more outcome-based, using what in my old job in the bank we call the program for results, the P4R approach, which is results-based financing. And I know ADB has got a similar instrument as well. So the more we move towards outcome-based challenge mode and results-based financing, I think the better outcomes we're going to get, which of course requires the stepping up on monitoring as well and independent verification. So that's a little bit about my sector. And what we're going to do now is we're going to move on to the other panelists. First, I'm going to request the country director of ADB, Mr. Yokoyama. And I'm requesting each panelist to take not more than 10 to 12 minutes so that we can do a quick round of all four of you. And I think what the really interesting and enriching part of this would be the interaction with the audience and to get their views on it. So over to you, Mr. Yokoyama.
Secretary of Ministry of Drinking Water Supply, Mr. Iyer, distinguished panelists, ladies and gentlemen, on behalf of ADB, I'd like to thank this opportunity to speak on this subject of infrastructure initiatives in India. My presentation covers quickly the infrastructure financing requirement in India and kind of instruments that we have, ADB is promoting. Then the third is what we are particularly focusing on in terms of the infrastructure initiatives. First, just to recap about the Asian infrastructure requirement. ADB has done a study recently. The annual requirement in Asia is $1.5 trillion. If you take into account the climate change impact, $1.7 trillion. And in case of India, we note that there has been several interactions already, but the latest economic survey noted $180 billion requirement per year. And sector-wise, the lower chart shows the distribution of the actual last 5-year expenditure and the projected expenditure for this 18-22 year period. And as you see, the urban infrastructure has been a tremendous gap in terms of projected and actual expenditure. And actually, the Ministry of Urban Development has earlier noticed the India needs annually 1.5% of GDP invested in urban. But I think with this 5.5 trillion rupees, it's 0.5%. So there's still a huge gap in the urban space. And this is the status of the capital expenditure. This shows low-income states is getting higher capital outlay. But overall, due to the fiscal act, the increasing number of states are facing the fiscal constraint. So the role of development agencies like ADB is more on areas where the critical gap exists, like direct funding, but also leveraged financing, trying to mobilize private financing. So secondly, I just want to cover quickly the kind of instruments that we try to promote in our lending. The middle part, red shade section part is the multilateral lending. But multilateral lending needs to be increasingly tied up with the private sector lending. So we are growing, PPP operations are growing in our lending. And also at the same time, promoting the other local resource mobilization like land value capture and municipal resource mobilization. I just want to highlight that the importance of urban planning, and India tends to, urban pattern is horizontal sprawling, and this leads to costlier infrastructure and also inefficient transport, lower revenue per acre. Whereas I think nowadays urban minister, CEO of Niti Ayog quite emphasizing on the importance of proactive urbanization with urban planning. So this allows really the vertical development, efficient infrastructure, and efficient public transport and higher revenue acre. So this can lead to a very good virtuous circle. So this is something that we are trying to promote in our urban infrastructure investments. So the instruments, land value capture, municipal bond, all these measures become much easier when the land use planning is implemented. Then I will cover what ADB is doing in terms of the infrastructure initiatives to try to, particularly this slide covers, ADB has invested $40.5 billion over the past 30 years. And our operation is envisaging, at this moment we are providing $3 billion, envisaging to make it $4 billion per year in the next 5 years. And focusing on the 3 pillars. One is promoting industrial competitiveness and job creation. Second is focusing on the low-income states. Third is renewable and climate change initiatives. And this is our operations. We are trying to promote a kind of a trinity of annual approval, contract awards and disbursement go hand in hand. And thanks to DA's efforts, this is taking place with higher readiness and building capacities at the state level. So this is the foundation of our operation, and whatever new areas we go, we try to stick to this important execution, rapid execution in our operations. So these are some of the innovative financing that we have done recent years. And so PPP, hybrid annuity, and a bit more focus on the credit enhancement measures providing TA, and the climate investment fund, and the bottom part is the urban resource mobilization with land use planning. And I put down 2 examples. One is economic corridor investments. We have an opportunity to work with the Tamil Nadu, Andhra Pradesh, and Odisha governments to support their industrial development through corridor planning and investments. This can enable them to connect to Southeast Asian market, let alone Indian market, but also beyond. So initial phase was covered for Andhra Pradesh. Now we are going to Tamil Nadu. So this is a planning component and investment component. Planning component is a comprehensive development planning for the what's called the spine and network infrastructure. So the master planning is the industrial township planning through long-term land use planning. And then the investment is accompanying to implement the comprehensive development plan as well as the master plan. So this is the spine and network infrastructure identified. We have roads, rail grids, ports, and also urban and energy sector. So about $20 billion of infrastructure requirements have been identified, many of which have been taken by, say, the Bharatmala, Sagarmala, as well as railway 14K plan, and so on. But the state level, there's an opportunity work, ADB, agencies like ADB and AIB working together. And this is industrial nodes township planning. About 50,000 acres have been identified, and 4,000 hectares is identified as a spine and, startup areas. Then industrial consultation, then potential industries have been identified, and also some of the anchor investors have been identified, and the process also includes now envisaging the industrial township is putting into operation startup area by 2021. And ADB is providing loan support for the left side is infrastructure, and the right side is policy-based, and also comprehensive industrial promotion activities also implemented. And this will enable about 50% of the industrial township operation of the startup areas. And the good part of this is initial investment requires public investments, but gradually, once the industry comes, then the land can be sold to the industries, and then there's a property tax and the income tax and so on. So we envisage by this initial investment public sector, the next round, including the expansion of the industrial node, is to be undertaken by private capital utilization. So this is a kind of structure. Initially, blue part is the public investment, but our capacity building and also leveraging of the public investment capital to the private investment to the green color to the over the years. So the overall $1.4 billion of multilateral investments leads to $2.5 billion of industry infrastructure and $10 billion of agglomeration benefits to the region. And 0.3 million or 300,000 employment. And last 1 minute, we just want to cover the second initiative of the catalyzing investment northeastern states. So northeastern states has a big potential for regional integration. And we see a similarity of Assam and northeastern region with Chinese Yunnan. So Kunming has been now the industrial powerhouse for the Southeast Asia, but we see potential for the northeastern states in a similar development path, and we have been given opportunity to work with the Assam state government on the industrial planning. So this is a Yunnan experience. What it says is strategic planning has really motivated the industrial growth, including infrastructure investments. So this is 1992 in Southeast Asia, this is 2010, this is 2020. So we see northeastern region probably somewhere Yunnan's year 2000. So at Assam we are initiating a strategic study thanks to the government's request, and so the eastern side integration and western and eastern side integration, various infrastructure is being identified. So we have been undertaking the Assam strategic investment study, so connectivity, industrial development planning. We hope to identify lots of investment opportunities, again, for our investment, World Bank, and AIIB, NDB, and so on. And also have a BIMSTEC transport master plan updating. We are supporting BIMSTEC in this regard. And ADB is now preparing northeastern states a project preparatory facility. This is a new facility that government can borrow without commitment charges. So, and also the design can be done not only for ADB assistance, but all the other financing. So we hope that this kind of facilities can also, again, facilitate the catalyze the public sector investment, particularly in the northeastern region. So this is all, and we really appreciate the opportunities given by the government, and pretty much enthusiastic about moving ahead for industrialization and infrastructure investments. And we have plenty of opportunities to catalyze public-private investments, and this AIB conference provides a good opportunity to interact. Thank you very much.
Thank you very much, Mr. Yokoyama, and fascinating presentation. In particular, the opportunities in the Northeast with the Yunnan model, the Greater Mekong as well. So we might just take a couple of quick questions since we've just heard from the country director. If you have any quick questions or comments, maybe just a couple before we move on to the next presentation. So, would anyone like to ask any questions? Yeah, please. Could you just introduce yourself so that...
I am A.K. Padhi, I represent NABARD here.
Okay.
And I am very much impressed by the presentation Mr. Yokoyama gave over here. And he has understood the infrastructure requirement of India as well as the South Asian countries. And the importance he has highlighted the possibility of extending more business and trade relationship by building required infrastructure, and how it values to the lifestyles, to the economy, to the wealth creation of the country. That is very important. I am so much impressed. Thank you, sir.
Thank you. Yeah.
I have a clarification question. You said 300,000 jobs. That seems really small for this level of investment. Is that direct jobs, or it's only direct jobs, or does it include indirect jobs as well?
I think that focused on the startup area of the entire. So we have the state government has identified more than 55,000 acres, and startup the present investment is focusing on is about 4,000 acres. So the idea is this is a kind of process, step by step, taking long years, and so that amount is really from the small startup areas.
Yes, please. And I think that will be the last one before we move on to the next.
Good morning. My name is Aparna Das, and I represent German International Corporation here. I'm kind of impressed with this, mega or the macro level plan that you presented. That's the way the Northeast would be then shaped up. I'm wondering that where, like as an urban planner, I'm interested in knowing that how would the regional planning or the urban planning would be then juxtaposed with this kind of a thinking. Like when we are designing this startup areas or we are designing at this level, now to put this up at the regional context, how would those kind of institutional synergies would be made, and where would the regional and the urban planning would come it as a discipline? So, what is the thinking on that level?
Well, I think in the case of northeastern states, at this moment, the state government is identifying key spine network infrastructure connecting to the, say, Myanmar, and also the inland waterways to Bangladesh through Brahmaputra and through Meghna River basins. So on the basis of the regional planning, the process is to identify some industrial clusters, which could be very much closer, adjacent to the urban centers. So once the industrial clusters and the urban centers are identified, then the similar approach of Andhra Pradesh can be applied. So identifying the cluster area, undertaking the land use planning, then urban expansion and industrial investment can take place through a more kind of focused urban city areas.
Right, thank you very much. We'll now move on. I'm going to request Sujoy, who's the CEO of the National Investment and Infrastructure Fund. And Sujoy is going to give us the private sector, the private financing perspective in particular. Sujoy?
Thank you, Param. I'll just speak from here. So I listened to a presentation by Mr. Pratap a couple of weeks ago where he basically explained that the infrastructure deficit in India is running at about $90 billion a year. Now, what is happening inside that deficit is also very interesting, which is that private investment in infrastructure has declined. For a growing economy like India, we would want private investment in infrastructure to be at the level of about 8 to 9% a year. We are currently probably at half of that, maybe a little bit more than half of that. In the meantime, public expenditure is increasing substantially. So in 2014, 14-15 fiscal, public expenditure was at about 1.8 trillion Indian rupees, which is about $26 billion. Whereas in FY 18-19, it's going to be at 6 trillion Indian rupees, which is about $90 billion. Obviously, this has to change for us to be able to bridge the gap. Now, there's also, if we look at the evolution of PPPs and private investment in infrastructure in India, it's also actually quite an interesting evolution. For those of us who were investing in Indian infrastructure in the 90s, and that was the time I would say that PPP, infrastructure investment PPP 1.0 in India was starting, which was really the first decade. IDFC was created. It's good to see Partho here, who did a lot of work on the infrastructure frameworks, structures and so on at that time. So IDFC was created. IL&FS was very much involved. ICICI, L&T, everyone was basically working with the government to put in place structures to actually kickstart private investment in infrastructure. At that time, in the mid-90s, everything was basically greenfield. There was really nothing to buy, no assets to buy. Everything had to be built. And the first decade actually was quite good in setting up some of these structures. We came up with some of the sort of indigenous models, such as the annuity model of road investment, and the infrastructure frameworks, the model concession agreements developed to a point where by the time that the next decade came, which was also the decade which was pre-global financial crisis, when BRICS was basically the flavor of the month, there was a tremendous amount of capital, of both domestic and foreign capital that came into the infrastructure sector. And in that second decade, a lot of that capital came in actually with fairly poor underwriting standards, and things that should not have gotten financed got not only financing, but also got foreign investment into them. And of course, that led to some of the problems that we see with the infrastructure sector today. The third decade, which is the current decade that's ongoing, is actually, I find, also quite interesting because it shows the maturing of the infrastructure sector. I think lessons were learned about how to deal. Policymakers learned lessons about how to deal with issues. I think the improvement in what's happening in the highways and road sector is an example of solutions that are being brought by policymakers to support private investment. Banks, investors, everyone understood the risks of infrastructure building better. And interestingly enough, if we look at a couple of external validations of the PPP framework in India, first of all, if you look at the World Bank, which basically, there's about 1,300 PPP projects going on in India at this time. And the World Bank actually says India is one of the leading PPP countries in the world. This is also validated by the Economist, the EIU. In the Asia Pacific, they rank India as number 1 in what they call operational maturity for PPP projects. So all is not bad. I mean, there is an experience and there are learnings that are actually driving the current focus on PPPs. But perhaps in my mind, the most important, I would say, evolution or the most important aspect of the current private investment cycle in infrastructure is policymakers have understood that one size does not fit all. And the other aspect is that we are now also at a point where a lot of infrastructure has been built, which allows us to think about private investment into infrastructure in a different way. Moody's has done a number of studies which basically show, they look at a large number of loans across developed markets and emerging markets. The outcome of that study, and it's fairly consistent, they do this on a regular basis and every time it's more or less the same story. The difference in defaults and loss given defaults between developed markets and emerging markets are fairly significant pre-construction. Post-construction, there is practically no difference. And at the same point, in post-construction infrastructure, emerging markets yield investors, and this is on the debt side, almost 250 basis points more than developed markets. Hence, there is an interest, and this is understood by international investors. And there is a very clear interest among international investors to invest into infrastructure assets in India and in emerging markets post-construction. And I think the evolution of the market and the maturity of the frameworks, and now the focus of policymakers to actually give international investors what they desire, which is post-construction assets, is, I think, a significant movement in terms of how to attract capital into the infrastructure sector. There are a number of I would say, initiatives that the government has taken. NIF is one of them. I'll talk about NIF in a minute. But also the TOT transaction that was recently done. Mr. Pratap, I think you'll speak more to that. And also INVITs, where what we are offering now to international investors are post-construction investment opportunities in the private market and more in the public market, because liquidity, again, is something that is of great interest to many of these investors. And again, the INVITs structure, which is a listed structure, as it matures over time, as liquidity increases, I think is going to become an extremely interesting product for people to invest into. Let me talk a little bit about NIF and talk a bit about where we are. The concept of NIF is that the government has acted as an anchor investor or a sponsor of a new institution, which is a fund manager in infrastructure, for this fund manager to start different funds which will catalyze capital from international investors. The government has given us 20,000 crores, but they've been very clear. Their key focus, their key objective is to use that initial capital to bring in capital from others. If we simply took that 20,000 crores and invested it, their objective would not be fulfilled. What we want to do is take that 20,000 crores and bring in substantially more capital to leverage that initial investment by the government. Today where we are is that we have structured 3 funds. The first fund we are calling the NIF Master Fund. This is a fund that is focused more on operating assets and actually provides foreign investors with a channel to put in capital into various core infrastructure sectors in India. ADIA from Abu Dhabi was the first investor, but we've also brought in HDFC, ICICI, Kotak and Axis because we wanted domestic investors also, which is a very important signal, domestic private investors, which is a very important signal to international investors. Under that fund, we have made the first investment, which is a large-scale platform for ports and logistics. Our operating partner over there is DP World from Dubai. The idea is through this platform to build a substantial operation in ports and logistics, combining EXIM and domestic logistics. So what you see today is a lot of capital has gone into the EXIM sector, but very little capital has gone into the domestic logistics sector. And we believe that by combining the two, we create substantial scale and substantial consumer benefits, which of course will ultimately make the country more competitive and make its infrastructure more usable for customers who want to move goods and containers. The second fund that we have structured, and today AIIB is actually at its board discussing an investment in this fund, is a fund of funds. Now in a fund of funds, what we want to do is we want to invest in funds that are managed by third-party managers. In my view, it is very important for us not only to invest in transactions and projects, but also to create an ecosystem of local managers, of domestic managers who understand the sector and who have the capital to actually continually make investments in infrastructure. This is critical for the long-term development of the sector, and through the fund of funds, we hope to achieve that. And finally, the third fund, which we have just registered and we are going to start fundraising, is a very long-term fund which is aimed actually at doing large-scale both greenfield and brownfield projects. These are projects we will do probably 5-6 projects in that fund, but these will be projects that will make a substantial difference to bring solutions to some problem or the other. Now, the way we've structured the funds is we've been very clear. We wanted these funds to be long-term, so the master fund has a 15-year term with 3 extensions of a year each. The fund of funds is 13 years, and our ambition is to make the strategic fund, the third fund, 25 years. They are all local currency funds, and we were very clear, with user charges in India being paid in local currency, it doesn't make sense for us to raise US dollar funds. So we have actually asked, and people have agreed, to take the risk in Indian rupees, which we think over time is going to be an important currency internationally, and in a long-term fund, people will benefit from the growth of the underlying revenues as they pick up over time. We've also made in the fund of funds an investment in a climate fund where we have brought in a very strong manager, independent manager, and we are in the final stages of closing a fund in urban affordable housing, which we also see as a very important sector for NIF to be involved in. So over time, what we will have is we will have hopefully NIF as limited as the manager, who's managing multiple funds which are focused on different aspects of the infrastructure market. All of our goal in all of these funds will be to catalyze substantial international capital and domestic capital. What I'd love to do is start to bring pension funds, local pension funds, and local insurance companies into the infrastructure sector. And finally, what we will do is with the capital, we will create substantial counterparties, whether they be operating companies or they be managers, such that we can make a significant difference to the infrastructure sector. Now, I travel a lot on fundraising, and one thing is very clear. The large pool of capital in sovereigns and pension funds are moving more towards infrastructure, private infrastructure assets. The moment they look outside the OECD, they have to consider India as a critical market. India is perhaps the largest infrastructure market outside of the OECD. If we can structure ourselves properly, if the public response to some of the issues we have faced in the last cycle are addressed, and I do believe they are starting to get addressed, I think we have a tremendous opportunity to attract substantial amounts of capital. One thing we also have to do is create the right counterparties in India to absorb, private counterparties to absorb that kind of capital, because these guys operate with large numbers. And I think with the various initiatives that the government is taking, we're going to succeed to do that. So I remain actually quite optimistic that the infrastructure sector in India is evolving well, and that it will attract over time a substantial amount of international capital. Thank you.
Great. Thanks, Sujoy, for that fascinating presentation, tracing the 3 decades of and the lessons learned of private financing from the mid-90s onwards. And of course, one of the lessons you said, one size does not fit all. And then also giving us a sense of NIIF, what are those 3 funds, how each one is different. I think some fascinating opportunities opening up, and all your experience coming in from the IFC, I think it's bringing to bear. So let's take a couple of questions if you have for Sujoy. Any quick comments or any thoughts you might have before we move on to the next one? At the back.
Yeah, good afternoon. This is Deepak here from Elara Capital. Can you shed some light on the third fund that you're mentioning? What a 25-year time horizon. So, barring hydro and thermal assets, are you looking at which areas of infrastructure specifically focusing on for this domain? And secondly, what is the size that you're looking at? And will it be open for both equity and debt?
Thank you, Deepak. So, NIF is more focused on the equity space. Because I think the government's view was that there are enough public-private partnerships for debt, but there's actually not too many for equity. So our focus is very much equity. Most of our team, and I should have mentioned that what we also have to do is put in very strong governance in place with strong processes, which we have been doing over the last year, and have a team that understands the space. So we are focused more on equity. And I should have also mentioned the sizes of the fund. So the master fund is going to be somewhere in the range of 2 to 2.5 billion US equivalent, but we'll also have a substantial pool of co-investment. So we'll probably have something like $5 billion of capital available to invest in the master fund. The fund of funds will have about $1 billion, and the strategic fund we are expecting, again, somewhere in the range of 2 to 2.5 billion. In the strategic fund, what we want to do is, rather than have a very diversified approach, is literally focus on crucial projects in the country. So really look at projects that have a commercial, sort of over time, can provide good commercial returns, but clearly will take a long time to generate those returns. And that's why we want to do a 25-year fund. We are in the early stages of fundraising, so we'll have to see if we are successful in getting the money that we want for this fund. But really the idea will be to look at significant projects that, and I don't want to give examples over here, but really significant projects that solve crucial bottlenecks in our infrastructure networks. It could be roads, it could be different, it could be something to do with rail, it could be a large airport, whatever it may be. But core infrastructure, crucial project, and commercial, but it will take a long time to generate those returns. So that's what there have been some models in the same vein in Europe, which have worked well. And so we've learned from there, and that's what we want to do. And I think because we are NIIF, we can actually do something like that.
Thanks and all the best.
Thanks, Sujoy. Yes, please.
Yeah. I'm Shulkat Singh from Jadavpur University, Kolkata. I have just a clarification. Now we have increasing participation of
private sector, as you said, and as you stressed. Now, there is every risk of default as you go on. And if the returns don't come as you perceive, then and things go haywire, what happens next? Is there any checks and balances that you have things in place? And what is the kind of regulatory framework that you have which actually puts things in order?
Yeah, why don't you go ahead?
250 basis point premium that you mentioned between OECD and emerging economies, that's exactly the regulatory risk premium. So does that mean that there's not going to be any incremental investment? Because that's exactly the regulatory risk premium. It's very interesting what you said.
Maybe, you know more about this, Ruthinder, than I do, but the point is that post-construction, what the Moody's study shows is that the default risk and the loss given default is actually not that different between developed and emerging markets. So it's exactly, so at the end of the day, if you look at the outcomes, sort of taking into account the regulatory risk shows the foreign investors that they're actually getting a increased return for the same level of default and loss given default. So I think it's a good story, for emerging markets in general. But coming back to your point of, obviously as a fund manager, we live and die by the returns we generate over time. And our approach has been, in the first fund we have done, it's still early days for NIF. So our approach has been actually to focus the first fund on operating assets, thereby reducing the risk. So we are not shooting for the high returns, we are shooting for low returns with a lower level of risk taking. And we believe that we are going to be able to achieve those returns because one thing that we have seen so far, and as you said, investors have actually started to come in. Foreign investors have started to come into India to actually take that risk, and they feel that the returns are commensurate with the risk that they're taking. However, even today, the balance sheets of both corporates and banks have significant, they are stuck, right? And I think it's a good time actually also as an investor to buy some of these assets because you're getting them at a better price than you would otherwise. So hence, with a low risk strategy, we believe that we'll be able to manage those risks better than taking a much higher level of risk in terms of developing and constructing assets. The third fund that I mentioned, there we want to take risk. And the way we have actually addressed that risk is by the tenor of the fund. So what we are very clear, so our experience, again, my IFC experience shows that in India, if you came in with the right underwriting standards and if you gave it time, you actually do well. Because the underlying revenues are growing. I mean, there's a WPI adjustment that the revenues are getting. There's a growth of about 4-5%. And other than situations where things have really gotten awry, regulatory risk post-construction has not been that high. It's been much more manageable, and that's really been our focus on the first one.
Thank you, Sujay. I think Professor, if you don't mind, we'll come to, quick question because then we need to move on to the next,
See, I have a very specific question on PMAY and the role of NIIF in that.
PMAY urban or rural?
Urban, basically, because you talked about rural, but let me concentrate on the urban. You see, the revised target of 12 million shortage in the urban areas. The progress in the first 3 years was very abysmally low, 1.5 million. Now, presently, the sanctioning rate per month is 3 lakhs, which really means it will cross 2 million and we can reach the target. But the major worry is, last year, the sanctioned houses were not backed up by budgetary allocation. In fact, we calculated, even last year's thing required at least 20,000 crores of extra budgetary support this year. Instead of that, we find again 6,000 crores coming up, and the sanctioning rate is 3 lakhs per month. I just want to know how this deficit is going to be made up by NIIF. I mean, is there some kind of a policy of NIIF to come in a big way? Really, it's a massive support, financial support that PMAY vision requires.
So NIF is a early stage institution, right? So I have to manage. You know, my biggest challenge is managing expectations, which is we have to be able to
has got very used to now. He's already become a government wala,
we have to walk before we can jump and run, run and jump. Over time, we hope that NIF can play a substantial role in each of these sectors. Remember, we are not a government agency where we are simply allocating money into programs. We are looking for commercial opportunities, bringing in private sector capital such that government expenditure can be, there's a substitute or an alternative for government expenditure. Ultimately, I think the real scaling will be when the regulations are beneficial for large-scale private capital to come in. Look at what's happening in the commercial real estate arena. The substantial capital has come in from the Canadians, from the Singaporeans, and so on. Hopefully, over time, this happens to housing as well. Understood.
Thank you. So, thank you very much. We're going to move on now, but I just wanted to give you a little intro about Mr. Kumar Pratap. In this discussion in recent times about lateral entry and domain experts, I have to say that Vinay is maybe the most qualified domain expert in the sector which we're discussing today. He's Joint Secretary, Infrastructure, Policy and Finance in the Ministry of Finance. He's got an MBA from IIM Ahmedabad of Lucknow, and he's got a PhD from University of Maryland. He has written a book. He lectures widely, extensively. He's worked in the bank. He's been in the Indian Embassy in Washington. He's written a book called PPPs in Infrastructure, Managing the Challenges, published earlier this year, and which was published by Springer in Singapore. So Vinay is very well qualified. He's going to give you the government perspective. He's going to talk about initiatives taken on infrastructure financing. So over to Vinay. Vinay.
I'm filling up for Rohit Kumar Singh, who is credited to have given India the model which the Secretary also referred to in his talk and was referred to by Sojoy also, the toll of trade transfer model, brownfield asset monetization. Starting with the infrastructure financing landscape, India is spending big on infrastructure. We have spent $1 trillion over the last 10 years, 65 lakh crores of rupees, $1 trillion. The problem is that what we have attained in 10 years, we want to do in 5. And that's the infrastructure financing gap that Sujoy referred to. So while we want to invest about 180 to 200 billion per annum, about 7% of GDP on infrastructure, which is the right number for infrastructure investment for fast-growing economy. And as you would probably know, India is the fastest growing large economy in the world today. The private investment, in the overall investment pie is about 36-37% over the last decade. And this number has been coming down, which is a cause of worry. And that's why institutions like NIIF are being promoted by the government. India also has the second largest infrastructure deficit in the world. That's what McKinsey tells us. The highest is in Brazil. So we need massive investments into infrastructure. The three main sources of infrastructure funding: one is government budgetary support, second is the internal and extra budgetary resources of the public sector, and thirdly, the private investment. Now, the budgetary support is constrained by the FRBM. There is a trajectory of fiscal deficit reduction over which the government is committed to. We are about 3.5% of GDP. We want to bring this number down. So GBS, government budgetary support, cannot be more than the amount that is already being spent, and that's quite a lot. We as has been referred to, 6 trillion rupees, 6 lakh crores is the number for the 2018-19 budget from the public sector. Now, IEBR being the second component, bank lending is a major part of this. Here we have seen a slowdown from about 43% between 2000 to 2013 to about to less than 3% now in the past 3 years. So, and also the fact that the non-performing assets of the banking sector are going up. So you need newer methods of mobilizing resources, newer methods of funding infrastructure. Now, these are the 3 main initiatives that the government is working on. Brownfield asset monetization for infrastructure investment, where the TOT model is very important. A credit enhancement fund that is being created, and the main sponsor is a public sector financial company that goes by the name of IIFCL, and a new credit rating scale for infrastructure sectors. And I'll explain each of these initiatives. The government believes that brownfield asset monetization, since they're considerably de-risked in the sense that there are no, they're past land acquisition and environmental and forest clearance stages, so they are considerably de-risked. So they are more amenable to institutional investment from pension, insurance, and sovereign wealth funds. Here, the number that is being talked of, within these institutional investment category, about $100 trillion of investment is available. Less than 1% of this is devoted to infrastructure. The challenge is to increase this number, and countries the world over are trying this, both developed and developing. We in India feel that brownfield asset monetization presents one such opportunity. What is brownfield asset monetization? We, in the road sector, there is the TOT model that has been tried out. It is brownfield assets. These are built assets by the National Highway Authority of India, which have been given out, concessioned for the private sector, and we feel that this can be spread across infrastructure sectors, including transmission lines, gas networks, power plants, and railway tracks. We have calculated some numbers. We think that about 10%, 110 billion is what we are currently spending. We can do 10% more if we mainstream this initiative. The government has already raised 1.5 billion through the TOT model. Then there is a financial vehicle, which is the InvITs, the Infrastructure Investment Trust, and the Real Estate Investment Trust, which can be used here. This gets institutional investment, and then it is spent on these infrastructure assets with or without transferring operational control. In the case of TOT model, the operational control is transferred to the private sector. In InvITs that are there in the country, this has not taken place. So the political economy of privatization, which is there, that gets addressed through these models, because the money, these assets are not being privatized, and that's a very crucial difference between the divestment and brownfield asset monetization. These assets go over to the private sector for a limited period of time and for more infrastructure investment. The funds don't go into the consolidated fund of India. They go to the very agency which is monetizing its assets. These are very crucial differences. And here we have also seen that since these are brownfield assets, they have a revenue stream associated with it. And the reserve price can be calculated as the discounted value of these cash flows over the concession period. Anything above that is available as efficiency capital, and we have seen TOT model give us that. These are the basics. What is the TOT model? O&M and operation and maintenance of assets and collection of tolls is given over to the private sector for about a 30-year period. investor returns are de-risked. NHAI was very they made available to the private sector a lot of data, including drone images of the roads. And this is very important. Unless you give data, because much of infrastructure investment is sunk capital, unless you make data available, investors would not be interested. So NHAI must be complemented by the type of data rooms that they made available to prospective investors. Now, as said, the additional revenue was generated. The reserve price was the discounted cash flows over a 30-year concession period. That number was calculated as $1 billion. The money that NHAI got was $1.5 billion for 680 kilometers of roads. So it works out about $1 million per kilometer as additional premium. And this is the efficiency capital. This is the efficiency that is being unlocked through this model. Winning bidder was a foreign investor, Macquarie of Australia, and there was an Indian partner, O&M partner, Ashoka Buildcon. And there are numerous examples the world over which we have tried to copy through this model. Infrastructure investment trusts, there are 3 of them operational in India. These are, but the assets are being operated by the same companies that own these assets. So the political economy of privatization will not affect such transactions. Again, we have a lot of international experience in this. We're trying to mainstream these models across infrastructure sectors. I also wanted to talk about the credit enhancement fund that the government is creating. Now, because the PPP projects that are being implemented, the typical credit rating is BBB. Now, the regulatory thresholds of insurance and pension funds do not allow them to invest anything below AA. But by the very structure of PPP model, because it's a new company that is implementing it, and because there are no demonstrated cash flows, the 70% of the companies are rated BBB. So in order to enhance the ratings of these, the debt that these companies issue, the government is trying to create a credit enhancement fund with a corpus of 500 crores. IIFCL is the lead investor in this, and there are public sector banks. We are also in talks, we would be in talks with the AIIB to pick up part of this equity. Then finally, the new credit rating for infrastructure projects. The usual credit rating is based on probability of default. 1 rupee default even for a day makes it difficult for the lenders. Now, infrastructure projects, because their cash flows are protected by the concession agreement, and because they are termination payments, it is felt that these should be rated differently against a different scale. And the credit rating agencies have come out with what is called the expected loss scale, which is defined as probability of default multiplied by loss given default. The second term is quite small. So that's why the utility of this new scale. Credit rating agencies, including CRISIL, have come out with a 7-point rating scale. They have already introduced it. We are looking for regulatory recognition of the new credit rating scale so that insurance and pension funds can flow into infrastructure. IRDAI, the insurance regulator, has already accepted and has lowered the ceiling on probability of default. So these are the 3 initiatives that the Ministry of Finance is working on. Thank you.
Thank you very much, Vinay. And again, on these 3 initiatives, fascinating on that. NHAI, we didn't hear from, as you said, unfortunately, Mr. Singh couldn't make it, but I think you gave us a very good sense of these initiatives, particularly that NHAI one, which raised 1.5 billion. Any questions for the Joint Secretary? Yes, please.
May I add on
TOT?
Because so we actually were one of the bidders with a Canadian pension fund on TOT, And I was, the way NHAI and MORTH did this was extremely, very impressive. So the consultation that they went through with potential investors, the, taking in all the comments and addressing some of the concerns that people raised was fantastic. The one aspect that I also want to stress on is the size. So if this was a 100 million or 200 million US transaction, we would not have got this kind of valuation, and we would not have got this kind of interest. The reason we got the interest was because this was a large transaction. And hence we had, NIF actually partnered with PSP, one of the Canadian pension funds, and then we had Brookfield, we had Macquarie, and we had one of the Spanish construction companies who partnered with a local partner. I think it's been extremely well received internationally. A lot of people, international investors, are talking about TOT and Macquarie's bid there. And I think it presents an opportune moment to scale this, keeping in mind, of course, some of the learnings from TOT.
I think as Vinay said, the putting out of data, in particular, and using drones, and, so seeing is believing. Yeah, please.
Yeah. Just a clarificatory question. How does a credit enhancing fund really improve the credit? Is it taking over the risk? And then how does the credit enhancing fund finances itself?
As is clear from the SPV model, the average ratings are quite low because there's no demonstration, because it's a new company created for implementing that project. The credit enhancement fund, after its own due diligence, would take some of the risks onto itself and thereby raise the credit rating of these bonds issued by these companies. So in that sense, the asset liability mismatch that we have in bank financing of infrastructure would be covered through more institutional financing of infrastructure.
Thank you.
Obviously, there is a requirement of due diligence, and there would be a revenue stream associated with enhancing this. So the rate of returns that have been calculated initially are quite low. We were in talks with IFC, his company. They said we're not interested at this type of return. The initial returns were less than 3% in the first 2 years.
Yes.
Thanks. I think just to add to that credit enhancement fund, we've been involved in working with the ministry and ADB for creating that bond guarantee fund, which is what has morphed into the credit enhancement fund. So my question is that I think the size that is being talked about, I think it's an idea. I completely agree that yes, it will make a big difference to the infrastructure sector. But the size that is being talked about, the capital, it's not going to be enough to really make a meaningful difference. So my only submission would be that I think the government should look at it and enhance it very fast, instead of saying that, okay, fine, this is there, then we'll see how much we can fund and then we'll try and increase the capital. Unless we can take it up to a larger scale, this may not make a difference. Also, a related point is that I think the capital and the shareholders may not assign the institution that you're creating to itself be rated AAA so that it can give the credit enhancements. I think those are 2 points that I wanted to make on the fund.
Right. We wanted to, the Ministry of Finance, this is a budget announcement, 2016-17 budget announcement. The Ministry of Finance wanted to start small. We don't want a grandiose plan with suspect rate of returns to flounder in the initial period itself. We want to demonstrate the product and then escalate, much like the Smart City mission. I was on the board of directors of the Indore Smart City. The Indore Smart City that is being developed covers only 2% of the area of Indore. So the idea, and that costs about 5,100 crores. So the idea is to start small and replicate once you have demonstrated success. And all these agencies which are partnering with this fund are AAA rated. It's very important that it has a AAA rating in order to enhance the credit of these projects.
So just one other question related to the InvITs. I think we've had, I think again as a structure, that's a hybrid structure but it could be a good vehicle to really catalyze all the investments coming in from private as well as foreign capital. But we haven't seen too much of a success. So I just wanted your perspective on why is it just a time frame issue? Is it or is there any other regulatory issues which are actually hampering the success of InvITs? After the flurry of two, I think we've just seen one private InvIT come out.
Right. A few days ago, the private InvIT has come out. L&T has floated it. Before that, IRB at the transmission assets. We were talking to the sponsors of these products, and they're quite happy with the type of traction that it has seen. It takes some time for these financial vehicles to mainstream.
Okay, I think, thank you very much. I think we'll move on now to the last panelist. Professor Mathur really doesn't need any introduction. He's one of the gurus in the urban infrastructure sector. He's now, in his current avatar, he's a senior fellow and head of the urban studies at the Institute of Social Sciences. Professor, over to you.
Thank you. Thank you very much. The one good thing that this seminar has done is to put me back in connection with Mr. Iyer. I'm meeting him after 10 years. Earlier, we used to meet quite often. 2 points were made by Mr. Garg this morning. One point was that the world is flush with money. And as Ratan sort of put that in, that the savings rate are roughly about 22%. And not only that, there are pension funds roughly about $25 trillion waiting to be invested. The question is that despite all these funds being available, no one spends money on urban infrastructure. Now, where are the missing links there? And I think that is the question that I would propose to deal with in this particular session. I will, since this is the Ministry of Finance seminar and activity, let me try and connect what I'm going to say with the Ministry of Finance rather than the Ministry of Urban Development. Let's go back to the Finance Commission, the 14th Finance Commission. And what the Finance Commission has done is that raising the state share from 32% to 42%. Now, let's see how the state budgets have been affected by this change in as far as urban development is concerned. What has been the accretion to the urban development budget in the state budgets on urban development as a result of this increase from 32% to 42%? This is one. The second is that, which also flows from the Finance Commission, that there are now regular flows from the Finance Commission directed to municipalities. Let's see over the four Finance Commissions, how have these flows increased, and whether as a result of that increased flows, whether that has been invested in urban infrastructure. This is the second point. The third point is really the whole, also the Finance Commission part, and the restructuring of the centrally sponsored schemes that have been taken in relation to the National Development Agenda, Team 2022, and so on and so forth. To what extent the centrally sponsored scheme linked with urban development, whether the share of those centrally sponsored schemes has risen substantially, and what is it, and the reference that was made by Mr. Pratap on the smart cities, to what extent investments are getting affected as a result of these three. And the fourth point, of course, is the municipal finances, which are central to investment in urban infrastructure. Let's see some of the results. As a result of the increase in the state share, the state governments are currently investing anywhere between 30,000 to 35,000 crore in urban development. This is not necessarily urban infrastructure, but the total allocation that are being made and that are allocated for urban development are roughly about 30,000 to 35,000 crore in 2016-17. Let's look at the flows from the Finance Commission, which certainly have risen as far as municipalities are concerned. From a meager amount of 2,000 crore that was recommended by the 11th Finance Commission, now the 11th Finance Commission, now the 14th Finance Commission has recommended roughly about 87,000 crore for a period of 5 years for municipalities. That is the second component. The third component is really the centrally sponsored schemes, and there are 5 of them right now as far as urban development is concerned. It's starting with smart cities, seconded by Amrit program, the third one being Swachh Bharat, fourth is Housing for All, and the fifth one being Livelihood Program. All of these are part of the centrally sponsored scheme, of which 4 of them happen to be part of the National Development Agenda that was approved by the Governing Council of the Niti Aayog in the meeting that took place in 2016. Now, as a result of this, roughly about 16,000 crore gets spent. Once again, 2016-17, all these 5 centrally sponsored schemes account for roughly about 16,000 crore. And municipal finances, unfortunately, we do not have the figures for 2016-17, but we have to go back to 2012, 2013. The total money which is raised by them, both through taxes and the non-taxes, are 49,000 crore, and that was the year 2012, 2013. You put all of them together, and the total investment in urban infrastructure works out to roughly about 1.5, 1.6% of the GDP. With all these changes that have come into being over the past 5, 6, 7 years as a result of the various initiatives, total investment comes to that one. Now the question obviously arises, what's wrong? Why is it not 3% recommended by HPC, and McKinsey itself said that our current investment levels are just about $17 per capita as against $136, which ought to be invested in urban infrastructure on an annual basis, and so forth. Now, our approach has been so far, and it was referred to in different ways, through 4 instruments. Change property taxes. Ratin is very much here, sitting in the 13th Finance Commission, working on it very laboriously. Change the user charge systems, 2. Number 3, bring in the PPP. And the 4th one is improve credit rating, enter municipal bonds, and so on and so forth, and that is where. Nothing seems to be happening on these 4 fronts, or very little seems to be happening on these 4 fronts. And the more deeply you enter into property taxation and user charge and municipal bond and the PPP, changes have been made. They are more anecdotal rather than very substantive changes in the systems. Now, 4 or 5 options that we've been working on, and as a result of this seminar, we have been looking at some of the details very, very closely. The missing links are the 4 or 5 that struck me as important, one of which was referred to by Mr. Pratap a minute ago. But the first one being, can we think something of the kind FRBM at the level of municipalities? Some responsibility, some kind of responsibility. How long would we go with a soft budget at the level of municipalities where they virtually do not raise any money? Can we think in terms of some responsibility in terms of revenue generation at the level of municipalities, a different kind of FRVM, but certainly of the same genes. Genes are the same, but the question that needs to be examined at some detail. Second point is, which really deals with the municipal bonds, and we have got tired of that over these years, which really started in a big way with 1997, with Ahmedabad, and followed by 21 other municipal bonds. Now there's a complete plateauing of that market. No one is really issuing any bond. Latest one, of course, is Pune, the smart city program that did issue that one. But there's not very many cities are coming forward. And once again, the question arises: why is it that bond market not flourishing? 2 or 3 things. One is that if you look at all these centrally sponsored schemes, is there an unintended consequences of this money flowing into urban infrastructure, which is constraining cities from going into the market. This is grant money. Now, if you're getting grant money, why would you really go to the market and raise a loan? Now, the unintended consequences of both the NURM to begin with and now these 5 missions, which have grant money, why would you go to the market if the money is available? So one need to examine whether the interpretation of our interpretation in respect of the CSS grant money is right or wrong. One. The second is the way and this point was mentioned by Mr. Pratap, the way we do the rating of municipalities and of the instruments. You see, unlike in the case of the states, where the shared revenues form a part of the state revenues, all the tax devolution from 32 to 42, the shared revenues between the state and the center do not enter into the own revenues of the municipalities for rating purposes. They are still treated as transfers. And when CRISIL or ICRA or CARE looks at the budgets of the municipalities, they look at it as a transfer rather than its own revenue of the municipal governments. That system of using tax devolution to municipalities not being a part of own revenue is a very major constraint in getting a better rating as far as municipalities are concerned. So a reconsideration of these mechanisms, and as Mr. Pratap said, we are relooking at the rating, and many of the agencies are re-examining it. I think we need to examine this a little more closely. The fourth one is really, and I think this point was very well elaborated by him, the new wealth of cities is really the assets of the municipalities themselves. And there are now cases where the municipal assets are being leased out both for upgradation, and these are the revenue generating municipal assets, not the dead ones, for long-term lease both for upgradation and maintenance and operation on a 30-year or 35-year lease where they can upgrade it the way they like it. It's a water supply project, and the DGB in Delhi. Why would the DGB in Delhi not be given on a lease to a private party that would upgrade it, that would run it, that would maintain it for a period of 30 years, lease it? And these kinds of things seem to be happening on a bigger scale in many of the developed countries right now. In fact, there's a very interesting book which is The New Wealth of Cities, really talking of the assets of the municipalities in a big way. Fourth one. The fifth one is, I don't know where are we lacking. There are three local taxes which are now part of the GST. Entry tax, advertisement tax, and entertainment tax. They form a part of the GST now. We have really not heard any discussion so far as to the sharing of the state revenues by the state with local bodies. Where are these local governments in their business? I do not know whether Ratin knows it or not, but we have really not seen any discussion on what kind of a sharing. Earlier there was a pool of resources at the level of the states which were being shared with municipalities. But now we do not know what is happening now. And the most recent budgets that we have seen, GST is not even mentioned in the budgets of the municipalities. What kind of sharing is taking place, we have no idea about this. And the last point is the whole business of economic appraisal, the way our projects are appraised, and that certainly is for larger projects as well as for international projects. What we have been used to is environmental clearances along with the financial appraisal, or the R&R incorporated within the financial appraisal. Can we bring in the SDG as a part of the economic appraisal project together with the financial appraisal that goes on anyway? Now, we have been talking about SDG, but we have really not seen the SDG getting translated into projects taking care of the requirements, whether it is SDG 11 or whether it is SDG 1 or whether SDG 6 or many others. I do not know others because I don't deal with them, but certainly the SDG 11. Why would the economic appraisal not include that? And the final is really the land values and land business, which is a highly complicated business. But what we do know is that land values are rising. Many, I mean, like Amitabh's presentation, whether it's land value capture or whether it is a tax increment, they all get linked with land. But they appropriated by who? Who is appropriating these increase in the land values? And after appropriation, where do these actually go? And how much of that appropriation goes into investment, and how much of that goes into infrastructure investment? We have no idea at all. We have no idea at all. I mean, there might be one or two cases and so on and so forth, but we really don't know. Now, these are the 4 or 5 things where I guess we need to do much more work. These are merely for exploration, but thanks to the seminar, at least it enabled me to think about these things and place it before this conference. Thank you very much.
Thank you so much, Professor Mathur, and quite an eye-opener. All that money being invested, but none of it, or very little going into the urban sector.
The private cost of inadequate urban infrastructure has been rising enormously. We all are making our own arrangements.
And with urbanization increasing, cities, the engines of growth, that money needs to come in.
That's right.
You have identified some of the potential elements or the bottlenecks. So let's get a few questions for
Absolutely.
Professor Mathur. I know you have to leave. We will close at 1:30.
1:30.
Yeah. So, but let's. Any questions for Professor Mathur? Ratin?
No, I just wanted to clarify about the GST. It's actually, you see, the reason why the GST is shared with states is that there are taxes that were not part of the divisible pool that are now partially in the divisible pool. So it's a special arrangement. Otherwise, the state finance commissions have full liberty to decide the difference. So just a clarification. I mean, any state finance commission principal could say, I'll share this much of my GST with them, or I'll increase my share in divisible pool to compensate for the subsuming of entertainment and other things, octroi, into GST.
No overall view on it.
No, there cannot be, because the whole point of GST is to integrate taxes and put them in the divisible pool. So that would be counter to the direction we are going.
Okay.
My question to you is this, that I would submit to you. It's very interesting. I'm from Maharashtra. I was outside and I saw this usual, government chap coming with people like bees around him, not doing much. Somebody on inspection, PM is coming. So I looked, I know the IAS here. So the person was from the MMRDA, not from the Bombay Municipal Corporation. And that set me thinking when you were speaking, that all these, could another factor be the fact that the Municipal Commissioner of Bombay reports to the Chief Secretary of Maharashtra, not to an elected authority, which is actually, in the case of my metropolis, a reversal of what used to be. Could this be one reason why all these initiatives don't work? Because in China, that is not the case. In China, it is part of your career structure to become party boss of Shanghai and then move up. So I'd like your thoughts on that.
Any other? I'll take one more.
Yeah, maybe. Let's get Professor Kundu. It's a good question. No one knows who's the mayor of any city in India.
Yeah.
I think Professor Mathur has raised very many structural issues with regard to infrastructural financing in urban sector. With the world being flushed with money and pension funds and socially committed funds available everywhere, we find that urban India, where per capita income by the last estimate is at least 120% more than the rural income, even consumption expenditure is much higher. You find even there, the private sector investment in infrastructure funding is not coming up to the extent we expected. And as Pratap mentioned, that even if you take 2% of the area under smart city mission, area-based thing, Pan City has much lower share than the area-based thing. And you pick up the area which can really pay for the capital. And still you find that the private sector participation is very, very low. Now that really raises